Okay, so credit markets, right? Looks
Yeah.
like you want to like really get a handle on this whole thing from
Yeah.
like the basics, who are the players, and what does it all mean for like, someone trying to understand it all.
Right.
Yeah, and looking at the stuff you sent over, I mean, we're talking government bonds, corporate bonds, municipal bonds, asset-backed securities,
Whoa.
collateralized debt obligations, even credit default swaps.
Wow. That's,
Yeah, and then you even threw in some leverage loans and high-yield bonds.
sure.
We got bank loans in here, mortgage-backed securities, commercial paper, emerging market bonds. That's a pretty wide range.
It is. It is.
Don't worry, though. We're gonna break it all down.
Yeah.
Make it make sense for everybody.
Absolutely.
So it's kind of like a cheat sheet to understanding this whole world. And I think there's some really interesting examples in here that we can pull out for people to really watch out for.
You know, it's interesting. You could actually think about credit risk like a spice scale, from mild to super spicy.
Oh, I like that. Yeah.
Yeah.
Tell me more about this spice scale.
Well, on the mild end, you have your government bonds. They're considered super safe because they're backed by the government's ability to tax, right?
Makes sense.
And so they're, pretty low risk. But low risk usually means a lower potential return.
Okay, so that's like the plain rice of investment. It's reliable, but it's not very exciting.
Exactly. Then, as we move up the spice scale, things get a little more interesting. Corporate bonds issued by companies carry a bit more risk than government bonds, so they offer a little more potential return.
Okay, all right.
And then we get to the really spicy stuff.
Okay, now you got me. What's the ghost pepper of the credit market?
Think leveraged loans and high-yield bonds.
Oh, yeah.
Sometimes called junk bonds.
Junk bonds, yeah.
Now, they're called junk for a reason, right? They're issued by companies with lower credit ratings, meaning there's a higher statistical probability that they might default on their payments.
Okay, so if they're so risky, why would anybody invest in them?
That's a good question.
Yeah, isn't that just gambling at that point?
Not necessarily. You see, to compensate for that higher risk, junk bonds offer much higher yields. That's the trade-off, right? So a skilled investor who can properly assess and manage that risk can find opportunities for big returns.
Gotcha. So it's like finding those hidden gems in the rough. It's not just, throwing money at anything.
Exactly. A calculated gamble.
Okay, that makes sense. Let's go back for a second. You mentioned some acronyms earlier, ABSs and CDOs.
Yeah.
I gotta admit, those always make my head spin a little bit.
I get it. They can be a little intimidating.
Yeah.
So think of asset-backed securities, ABSs, as a big basket of loans. Mortgages, auto loans, credit card debt, all bundled together. Investors buy into that basket and get paid based on the payments from those loans.
Okay, I think I'm following so far, but CDOs sound even more complicated.
Right. Collateralized debt obligations, CDOs, are basically bundles of those ABS baskets. Imagine taking a bunch of different ABSs, each with different risk levels, and then bundling those together.
So why is that so risky? It just sounds like a bigger basket.
Well, that's where things get a little tricky. Remember the 2008 financial crisis?
Oh.
These CDOs played a big role in that. Because they were so complex and interconnected, it was hard to understand the real risk hidden within them.
Okay.
When housing prices started to drop and those mortgage-backed securities started failing, well, it triggered this chain reaction like a Jenga tower collapsing.
So these CDOs amplified and spread the risk throughout the whole system. That's scary stuff.
It can be, yeah.
Okay, let's change gears a bit. You also had some material here on emerging market bonds. Those sound a bit like the adventure travel of investing, right?
Yeah, there's definitely a higher risk-reward dynamic at play there. You're investing in the potential growth of developing economies, which can be explosive. But these markets can also be very volatile. You really need to understand the specific country or company, its political landscape, its economic vulnerabilities.
Okay, so it's not just about chasing those high yields. It's about, really understanding the underlying risks.
Yeah.
So much for throwing darts at a map.
Right.
So thinking about everything we've discussed, where do you think you, as our listener, might fall on this credit market spice scale? Are you more comfortable with the mild, predictable government bonds? Or are you looking for something a little spicier?
That's a great question. Knowing your own risk tolerance is absolutely crucial. Are you comfortable with a certain level of volatility, or do you really prioritize that stability?
It's like choosing between a mild salsa and a habanero hot sauce. You need to know what you can handle.
Exactly.
So we've covered a lot of ground here, from the safe and steady government bonds to the high-stakes world of junk bonds and beyond. It's clear that credit markets offer a huge range of options, each with its own risk and reward profile.
And that's the key takeaway, really. Understanding the basics can help you make more informed decisions and navigate this complex world. Here's something to think about. Interest rates are constantly changing, and the global economy is always in flux, right? Which parts of the credit market seem most promising or risky to you right now? It's a question worth pondering, I think.
That's a great point. And remember, this deep dive is just a starting point. If something piqued your interest today, keep exploring. The world of credit markets is constantly evolving, and there's always more to learn. Who knows, you might discover your next big investment opportunity.
That's right.
Happy exploring.
Happy exploring.